I want to preface this lecture by first saying that what we're looking at here, value stocks, is a bit different from what we're going to be looking at in the next lecture, which is defensive stocks. The main difference is that for value stocks, we are buying during the bear market. We're buying because we believe the value stocks are undervalued, and I'll explain why in a second. But the next lecture talks about the stocks you buy before the bear market comes. So one is modifying your portfolio before the market crash, and another is modifying your portfolio during the market crash. I want to make that very clear. So value stocks is for buying during a market crash, not for preparing for a market crash. Okay? The idea of a value stock is that it's for a company that's always going to do well and will be able to weather a economic storm. And for the investor, what that means is, well, it's going to be a decent addition to any portfolio, but it's going to be especially decent to your portfolio after the market returns, because these are the stocks that will also return along with the market. Some companies will be hit by the market crash and might go bankrupt, might go under, might suffer long-term problems. But value stocks generally will not. Value stocks will come back to their original values and probably continue upward. Now, the sad thing is that value stock usually doesn't deserve to get hit by a market crash, but it does anyway. So, a stock that is for a company that's going to be doing well and might have just a small problem during the market crash is actually going to fall quite a bit during the market crash just because that's how a market crash works. Right? It's a bit different from the defensive stocks we're to look at in the next lecture. So that's one of the things you need to know. And when we talk about beta in the next lecture, you'll understand the key difference between a value stock and a defensive stock. But let's go over the characteristics of a value stock. First of all, a value stock is going to pay out in dividends. This is usually because a company that is doing quite well and is already done with its growth and is now at a stable part of its lifetime doesn't need investor money to continue expansion. Instead, what they do is they take their profits and they give them back to the investors because they think that the investors could actually do better with that money than the company itself can do. So a value stock is a stock that pays dividends. If you're looking at a stock that doesn't pay dividends, it means that it's probably a growth stock and it's reliant on the economy, it's reliant on growth, which is hampered by the economy. So it could stagnate during a market crash and then be hurt for some time afterwards. A value stock doesn't have that problem. If the stock value drops, they still pay you dividends. It's just that you're not going to get as much as you expected simply because the market crashed. But that's not always the case. Sometimes you will get as much as you expected, regardless of the market crash. So the first is that it pays dividends. The second is that the PE is low. The price to earnings is low. Generally, a high price to earnings means that there's a lot in store in the future for the company, so people are willing to put a lot of money into their investment and pay what seems to be overpriced um, amounts of money just to gain exposure to that stock because they believe something is going to happen that's going to make that stock price shoot up. But a stock with a PE that's low is a stock that has the impression that gives the investors an impression that nothing really new is coming in the future of this company. The company's pretty much going to remain where it is, and that's pretty much it. Coca-Cola might be an example of this. It's not like Coca-Cola has made any innovations since perhaps Diet Coke or maybe Coke Zero. They're just going to sell sugar water for the rest of their company's career. So a lot of investors are just saying, I'm not going to pay so and so price for this company if all they do is shove out the same sugar water year after year. And Coca-Cola knows this, and that's why they pay dividends. They want to attract investors because otherwise there's no reason to invest. So the PE is low. The price to book is also low. And I'm going to show you where to check out these variables in a second. Actually, I'll just do that now. So we can go and look at some examples. You're going to want to use a site called Morningstar, morningstar.com, and you can check out value stocks. You can check out whether a stock is a value stock by putting in the stock up here in the quote area. I'm going to do BAM, which is a asset management company. They're basically a financial company. And we're going to look at two things. We're going to look and see if there's a yield. For a value stock, you generally want a yield of around 2.5%. And what the yield means is that's how much you can expect to make back at the end of the year. Then we're going to look at the what we've got on here. We're going to look at the price per book and the price per earnings. And we hope to see green bars, because that means that the price to earnings is lower than the industry average and the price to book is lower than the industry average, which implies that this stock is a value stock, not a growth stock. Okay, so this would be a good buy during a market crash, because what's going to happen is the stock price is going to fall, but the company really doesn't deserve that fall. It's not like the company has changed what it does and it's going to be useful after the market returns to normal values. It's just that people are taking their money out of the stock market, and a sinking tide sinks all boats. So these will be hit. And you know that they're hit because you're watching the stock market during the crash. Remember, value stocks are bought during a crash. So that's an example. Another example would be, let me think here. A lot of technology sites or technology companies that people rely on for, regardless of what's happening in the market, will be considered value stocks. Yahoo's not that great because it doesn't offer a yield. So we're going to skip Yahoo. What's a technology? Okay, Cisco. Cisco is a technology stock. I believe they offer a yield. Yes, they do. And they offer a pretty good yield for a value stock. And their price to earnings and price to book are both low. They have the green bars. They're lower than the industry average. So this would be a good stock to buy as you see it fall during a market crash. It'll come back up. You'll get more than you expected for your dividend, and you'll be pretty good in the long run. So that's how you find a value stock. And remember, the key here is buy value stocks during a market crash, not in preparation of a crash. So what do you do in preparation of a crash? Well, that's the next lecture. So move on to defensive stocks, and we will talk about preparing your portfolio for a market crash by buying certain stocks.